All right. Hello, 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 hello. Good afternoon. Welcome. Thanks for coming out. Thanks for tuning in. Hopefully you're dry and you're warm wherever you are. And we're here to just chat for a little bit. So my name is Jim Kuchar. I am Associate Professor of Social Innovation at the University of Maryland, Baltimore. We are happy to be the sponsor of this event. And we're going to talk about money, and we're going to talk about some unique and emerging kinds of money. And I'm happy to say that I've got two folks with me that have forgotten more about this than I will ever learn. And the first is Mark Kaufman, who is president of the Neighborhood Impact Investing Fund here in Baltimore. And the other is Bridget Peterson, who is a partner at Brown Advisory and head of the endowments practice. So first things first, we would love to engage with you folks in whatever questions, conversations, thoughts, or stray notions you may have. And don't worry about whether they are on topic, off topic, or completely in another ballpark. We're happy to chat, and we'd much rather do that than sit here and talk for a while. So that's rule number one. And I believe we've got some sort of methodology for figuring out when folks have questions online. And then the other thing is, I'm going to sort of half moderate, half participate, but the other thing I want to make sure is all three of us, I think, suffer from a similar disease, which is we really love this particular topic, and because of that, we tend to get kind of technical at times. So I'm going to try and translate when I can, but if you hear an acronym or a term or a phrase that makes you go, huh? Just throw something at us and we'll try to decode that as best we can. Okay? So, money is always hard to get for any entrepreneur. That's just a fact, regardless of what the venture is, what your goal is, where you're trying to build it. Capital access is always a tricky thing to do, and it requires sort of a decent combination of timing and salesperson skills. And I think perhaps, for me anyway, the most lacking part of capital access is you got to make sure you know how to run a set of numbers and show people how they can get something back for their money. And I think with a lot of young entrepreneurs, they sort of have this concept that if I just convince people of how passionate I am and how wonderful this idea is and what great an opportunity is, then we're good, and the numbers don't really kind of fall into place. And I'm getting nods from my colleagues here, so I'm thinking that's a correct assumption. So what we're going to kind of focus in the next little bit is a different kind of capital that has some different expectations to it in some cases, and maybe doesn't have the same expectation, that maybe doesn't have different expectations in other places. That's kind of one of the great debates. But it's capital that is interested in not just a financial return, but also some sort of a return that can demonstrate some level of positive impact on society. So let's start there. Let's start with like the whole notion of return on investment, which I think is another basic concept that a lot of entrepreneurs struggle with just in general. It's like, how do you even demonstrate that? So I'll just throw a jump ball to you guys.
Sure, so I'll start. So we work with a number of different folks, and return is always front of mind. So if you think about the types of organizations we work with, most of them are really deeply engaged in community. They are very connected to purpose. And then they have this pool of assets sitting there. And historically, the purpose of that pool of assets was to drive financial return for the organization so the organization could just do more good work. I think we've all understood more recently that there's a lot more that can be done with that pool of assets that's sitting there beyond simply financial return. Now, of course, financial return has to be a part of that for the organization.
This is the
to
woman with the
continue.
investment management world, by the way. So just to clarify that.
But increasingly, we are seeing board members and investment committee members saying, is there a way that we can find more mission alignment, as it were, with our investable assets? And so they think about a little bit more now investment return as performance, certainly, but also how are those assets being used to further their organizational mission and purpose? And so more and more, we're talking about kind of what does social return look like? What does impact return look like? And we're being asked to help clients really think through that. And there's a number of different ways that they can get there, and we'll dive into all that.
So is it fair to say, Bridget, that in your world, financial return on investment is almost the entry point, the gateway, the minimum, and then the social good is on top of that?
So I think it's yes and no. So for some organizations where their board and committee are highly focused on ensuring that they have funds to operate, funds to take their organization to the next level, yes, financial return absolutely is the baseline. And if they can find a way to bring in social return or impact into the portfolio, then that's a bonus, and that's fantastic. For other organizations, I think about foundations that have been around for a long, long time. For some of them, they're thinking, it's okay if our financial returns are not what maybe we expected of them the last, 2 decades, but rather, could we, take 100 basis points off and add on a little bit more impact? I think there's more flexibility when you're dealing with kind of private capital like that, as opposed to more public funds.
I think one of the things that people don't quite understand about how philanthropic organizations, meaning foundations, structured philanthropy works is they do make grants, but they also have an investment pool to continue to keep those grants endowed. And I think that's what you're talking about in terms of accepting the lower return.
That's right.
On the investment pool.
So if you think about most private foundations have to distribute 5% of their assets over time every year toward grants or toward purpose-driven programming. And so sometimes you now are seeing committees and boards saying, you know what, it's okay if we're not earning so much more above that if we're able to kind of drive more impact through those funds.
So there's a spectrum. I know, Mark, you have thoughts on this.
Well, so we're on excuse me, I run the Neighborhood Impact Investment Fund. We're what's known as a community development financial institution, which is a mission-focused, in our case, lender. We were capitalized by the city, and we're a separate nonprofit now. So as we invest, we're not looking to drive investment return. We're looking to keep the lights on. We need to get our money back. But we're looking to drive, and we're eligible to invest in about 65% of the city, which is a geographic set of boundaries, focused on neighborhoods that have historically, in my 50-some-odd years living in Baltimore, not seen much. But I see it from the other side in terms of people gathering capital on our side. And there are investors across the spectrum who have different objectives, some more return-focused, some more getting impact-focused. One of the challenges that anyone raising capital, and on the liability side of our balance sheet, we have the same questions. How do we raise capital, lending capital, et cetera, is trying to put together the pieces of that puzzle so that you can offer investors what they particularly might want. So some investors are more focused on return of capital. Some investors are more focused on impact. To the extent you're large enough, you can hopefully, what we would try to do is string together a little bit of both, so that you can provide the investors who want certainty, a lower return, but more certainty, and provide investors who are willing to take a little more risk and drive more impact, help them drive the impact, and use the two to, I hate to say cross-subsidize one another, but really to support a capital plan that can fund both purposes.
Yeah, so I mentioned a minute ago that there's things that are different about this world of impact investing. There's things that are very much the same, and I think one of the things that's the same as it is in any sort of capital structure for any startup is kind of in terms of relationships with investors and deal structure. When you've seen one, you've kind of only seen one, right? So every single deal, whether it's a VC deal that's going to have a massive return and an eventual IPO, whether it's an impact investing deal, whether it's a philanthropic grant, there's always kind of a one-on-one custom tailoring, I guess, for lack of a better term. And that's I think what you're hearing here is that there are different people that have different appetites for how much of this do I need to get my money back or to see a specific percentage return above that, and how much of this is it's okay if I don't get the money back, which is the traditional grant structure, as long as I know that it's doing good. And as you're hearing, it's all over the map. So I apologize in advance if you came here looking for a magic formula, because anyway.
Well, can I just pick up
Please,
on that?
please.
The pieces, to make it, I guess, somewhat more complicated, but in some ways simpler, the pieces can complement one another. So we try to help our borrowers structure investments to get raise the capital they need to do what they want to do. Part of what we are trying to do is find other sources that can complement in that transaction, for example, what we are doing so that we can do it. So for example, in many cases in the deals we do, flat out subsidy is required. The building costs more to renovate than it's going to be worth when it's done.
So by flat out subsidy, what he means is it's never actually going to return
Right.
true dollars
Right.
like you would like on a bank note or a mortgage or a car loan.
Many providers of subsidy are willing to provide the subsidy, but the structure in which it comes creates issues. In particular, many want to provide it after the building is built. So someone will reimburse you for doing something and having an impact that they wanted you to have, but they want to make sure that impact gets had before they provide the capital. That's fine, except that in many cases the entity trying to do the development doesn't have the capital up front to get the building renovated to get to the reimbursement. We provide bridge loans for those situations. So essentially we're providing the upfront capital, and when the subsidy is provided, the project is then completed, we get our money back. The two pieces work together. We are providing an impact loan, but don't kid yourself, without the subsidy at the end, which is driving the impact, we can't get there. And none of us are going to get there. So trying to figure out how to put pieces together to meet one person's need and then find someone else who can perhaps complement it may be an effective way to get there in a lot of situations.
And so what you're seeing in those kinds of situations is a combination of different types of money that have different expectations. So you might have direct charity, individual donations. You might have structured philanthropy where you have a foundation that gives you a grant. And then you might also have capital that's got an investment expectation to it, all kind of coming in at the same time, which also gets very interesting because now you're dealing with not only a mixed, what they call capital stack, but you're also dealing with funders that have very different expectations, one from the other, all kind of sitting at your kitchen table talking about what you're cooking for dinner, which kind of gets interesting.
I think that's one of the reasons why, for me, we talk a lot about Baltimore being small-to-more in some ways and very much not in others, but the community in terms of the asset allocators or the funders very much know each other, right? And so what I think is really cool is that there's a lot of talk, a lot of collaboration, where if a foundation is interested in doing some investments in the form of maybe a debt structure or a loan, there is a lot of talk and understanding of, is there a subsidy happening up front or on the back end, or how is that all going to work? And so Foundation A might talk to Foundation B and say, hey, are you funding this? Are you going to provide a loan loss reserve on this? Because that would really entice us to then invest in this way. And so that type of collaboration, I think, happens a lot more than maybe we might think.
So loan loss reserve, plain English interpretation of that, please.
Sure. So if an organization decides to invest and provide a loan to a borrower, and that borrower otherwise does not have kind of the balance sheet that you might otherwise think of in traditional lending, there's a higher risk to the lender. And so the lender wants to know that if something were to go wrong, that there is a pool of capital available to satisfy that loan. And so that loan loss reserve is sometimes built up by an organization from a grant. Sometimes it's built up by other lenders. Sometimes an investor may even provide, in some ways, another loan loss reserve for other lenders. So But in short, a lender just wants to make sure that when they are lending to a borrower that otherwise doesn't have kind of the background and profile that would otherwise be approved through traditional financing, that it is not as risky as it might otherwise be.
So if you think about
about
a
right?
mortgage, you put up your house as collateral, right? And that's the kind of thing we're talking about here as well. I don't have a house for collateral, and I don't have any, business assets for collateral, but another entity will come in and say, okay, I'll be the backstop in case the primary lender isn't receiving what they thought they were going to get.
That's right. Yeah.
Yes, please hang on one second. We got to do a little dance for the live stream here. I apologize. Thank you, Taylor.
Well, I guess I'll introduce myself. My name is Wayne Stewart. I'm the owner of Stewart Design Agency. So we're like a full-service digital marketing agency. My question was, so do loan officers or organizations ever take equity into the business in terms of their loans? Like, would you back the business that way in terms of having like some equity in the actual company itself?
I can speak for having been at a couple of CDFIs. The traditional lenders don't. Really, at the end of the day, we're not. Hey, my chief risk officer would hate me for saying this. We are an equity partner in our projects. We're just not in the legal documents, right? We're not invested in somebody's building to foreclose on it. I don't have anybody to operate it. We're investing in community facilities. They need to operate. So, not that we're not a lender, not that we don't act like a lender, not that we don't have a security interest, but at the end of the day, we need the project to work. And so, I don't really view it as, I will say I get frustrated at times from the other side. I was an investment banker before I did this work. I've worked on regular way transactions. I've seen how private equity and other people treat lenders as like complete adversaries. I get a little frustrated when we're sort of approached that way, in the sense that, like, we're not Chase Manhattan Bank. We're not going to foreclose on the thing. We need to get this project to work. And so, we approach every deal like we have equity, because at the end of the day, if the equity doesn't work, we're not going to put the place out of business and recover our debt anyway. So there really isn't that structure. What we're really trying to do is, in our case, is revolve the capital. So we need to get the money back to put it in the next deal. But we don't do, like private type real estate financing, which is give me a credit score and enough asset coverage, and I'll just make you the loan, because if it doesn't work, I'll just foreclose on the building and sell it. We're not doing that anyway.
So I want to thank you for grabbing our note list, because this is actually a point that we wanted to talk about this morning, which is just kind of the basic issues around different ways that the capital behaves in an organization, right? So just at a real basic level, debt is something that has a repayment structure, right? So you take out a car loan and you get a coupon book and you pay it every month, right? So maybe if it's a bank loan, maybe it's quarterly or annually, and there's more sophisticated versions of that we'll probably get into in a little bit. Equity has a totally different repayment expectation, where equity takes an actual ownership stake in your company, and their expectation is that they realize the return on that when the company has some sort of a liquidity event. It's sold, in a very rare case it goes public, those kinds of things. You wanted to add a point, and Taylor, if you would.
Yeah, I think the other point I'd add on to what Mark mentioned is that a number of these CDFIs, first of all, everybody's in this to see you succeed, right? That's the goal.
That's a vital point.
So a lot of these CDFIs are, and not just CDFIs. I think about some of the venture capital opportunities that are out there right now. Are we allowed to talk about them? Okay. So, but
it's your NDA, not mine.
but I think about these organizations that are providing the lending. Many of them are also providing kind of what we otherwise would call wraparound services, right? So they're part of an accelerator. So they're helping you think through what it means to kind of balance your books and figure out what your structure needs to look like. They're providing services beyond just the loan. And so in a sense, they are treating you as though they have equity, right? They just don't take the equity, right?
Yeah, they may not literally take the physical equity, meaning an actual document, but they're at the table.
Because they want you to succeed.
Okay, that makes sense. Yeah. Sir.
I have a sort of a blended question for both Mark and Bridget. Mark, from your introduction, you mentioned, as far as your organization is concerned, I think you made a distinction between what you were saying was return on capital and return of capital. And I think in your case, what you said is that the return of the capital is probably higher priority importance for you simply because you have to, as you said, keep the lights on, keep it going, bring it back and lend it out again. Bridget, you mentioned about some wiggle room in basis points, etc. when you give out loans, so you can take something. You may have a hurdle rate of return, but then if there's a social impact considerations over it, you can probably have some wiggle room in that. So if it's not 8%, 10%, whatever, you might say, well, it's a little bit lower on the basis points outright. But then there's whether it's job creation, whether it's some social impact, neighborhood uplift, whatever it is in there. So if I gather that correctly, what I would love to hear is a couple of examples from you guys, if you can share anything, of where you have gone out and the type of projects and what happened to them. So we can see from cradle to grave how that happened. It would just help the understanding a lot more.
Sure. So I'll jump in. So I'll give you an example of a client who it's a private foundation, and they have a expected return of their total portfolio of, say, 8%, right? And that's across their entire portfolio. That includes traditional fixed income, traditional stocks, private equity, private investments, venture. But they look at the entire portfolio and they say, what is the return we're hoping to achieve so that we can make our required distribution every year and earn some return on our capital? That client said, there are some investments we'd like to make that are debt-structured investments. They're private debt-structured investments. That in this case, it was a housing. It was a housing investment with some wraparound services that the investee provided. And this organization decided that they were comfortable with a lower rate of return than they otherwise would have expected from that type of private debt. So if that private debt were expected closer to, say, 8%, they were willing to take more of a 4 to 5% return on that private debt with a higher risk, right? So typically, when an investor takes more risk, they're looking for more return. In impact investing, sometimes you take higher risk and expect the same or lower return. And so this particular client said, you know what, we're willing to take somewhat of a lower return on that investment. They actually wanted to think of it as part of their fixed income portfolio, which it traditionally would be in another bucket of the portfolio. And they were able to still end up blending overall their return to their expected 8% because they could kind of manage the rest of the portfolio in a way to compensate for that. I mean, that's the thing. For institutions that are doing this type of investing, they have a broad portfolio. So they're not allocating 100% of their portfolio to impact investing. That most likely would not allow them to do the work that they do every day. They're allocating a piece of it. And so that means that they can think about that in the overall picture as opposed to just on an investment by investment basis. Does that make sense?
It does. And so Baltimore does have pools of money or organizations that are looking for that type of a blended return in that case?
Oh, absolutely. Yeah, absolutely. Do you want to talk about that maybe?
Yeah, I mean, I can give you rate examples. I mean, typically, and this, again, most of what we're doing is real estate related, so there's some security involved, but typical lenders are, call it, I mean, we lend at about 5%. We have capital from the city that is inexpensive that we have for a term, so that funds that. But a typical lender is 400 to 500 basis points over where their cost of funds is. Their cost of funds, where they borrow their money, so they're 4 to 5% over where they borrow money. Hopefully,
I'm sorry, Mark. I borrow money and I lend it back out. Right. And what he's talking about is the difference between what I'm paying when I borrow it and what I'm getting when I lend it out.
Right. So if you could borrow at 0, you could lend at 4 or 5. They can't borrow at 0. When cost of funds up until recently, when rates went up, was relatively inexpensive, they were able to borrow inexpensively. They do what Bridget was talking about, which is they go out and try to source grant capital to complement the borrowed money to bring their blended cost down to pass that along. And so that was running kind of 6-ish neighborhood. interest rates are probably up 200 to 300 basis points now, and that's going to creep up right along with it. So what was 6 neighborhood is, I think, probably in the 8s, 7, somewhere in that zip code. Again, we haven't really been forced to do that because we have excess capital that we borrowed when we started the fund, and until that goes out the door, we're just, again, most of these lenders are nonprofits. They're trying to cover costs, cover losses, and keep the lights on and deliver on the mission. They're not trying to, fulfill a bottom line goal. I can back up. So we were set up in 2019. We've committed about $35 million. We've got about 25 committed now. Some of the other loans have paid back, and we've put about, if you look today, there's probably 18 million on the street.
So the one thing I'd say is Mark mentioned, and we've mentioned kind of several times, these are investors who otherwise have, for lack of a better term, day jobs or purpose, right? So their primary purpose is not to do impact investing. So many of them will look at, especially with debt, and say, you know what, we're not really interested in giving individual loans out. That's just too much for our staff to have to deal with when they are trying to run another operation over here. And so the one thing I will say is there are a number of different intermediaries, both locally and nationally, who are really well respected, who do really incredible work, where borrowers can go through an intermediary and say, NIF is one. I think about Baltimore Community Lending. You've got TEDCO back here. There's a lot of different organizations that are doing this work, and they're set up to provide those types of loans to the end borrower, and they are set up to provide the type of reporting to the lender. So just want to make a comment.
And they also serve a good role in terms of validating the prospective borrower to the lending pool as well. So they serve as kind of an intermediary on both points. And I get to your question over here in just one second. I'm going to set these guys off, and then we'll get the mic to you while they're chatting. So one of the other things that we wanted to get you guys to sort of riff on for a minute is that in addition to the fact that the deals are all different, there's also kind of different appetites in terms of, I guess, for lack of a better term, type of cuisine, right? So there's some people that are interested in things that are more environmental. There's some people that are interested more in things that are perhaps human service related. So chat about that a little bit while we get the mic over here.
Yeah, so in our case, we do housing, community facilities, and we're place-based. So we're very focused and interested in Baltimore City. Other funds are place agnostic. Other funds are product specific. In our case, because we only invest in a limited geographic area, I would say to people, we're place specific and product flexible. There's not enough of any one thing to do in 65% of Baltimore City for us as it is. So we are constantly trying to figure out different ways, different products that will work. And frankly, we're in a probably not dissimilar position than some of the venture-oriented companies here, where, tomorrow's product is whatever we can do today, and then we're going to run that play again. And so, we're trying to figure out where there's a market need that we can fill and meet those needs as you go forward. I do think it is about trying to put together different sources, whether you're in your own company or somebody like us raising money, different sources of capital that can complement one another. Different investors have different agendas, and ideally you can find, in many cases, 2 of them that complement one another. One of them wants to take a lot of risk, see a lot of return, but doesn't have enough money. The other one doesn't want to take as much risk, but has more capital. If you can put the 2 of them together, you can hopefully meet somebody's need. And we try to do that. I'm sure as fundies, you're going to wind up in the same position. It's confusing. The only good news, and I think this is where Bridget said, is it's a pretty collaborative universe. This isn't Citibank competing with Chase. The people are not in this to try to elbow out the other providers. In fact, it's much more the opposite. It's, hey, can we club somebody else in who has some pool of capital that we don't have? It reminds me a little of, I had a daughter that was applying for college, and one of the college reps said, there's a whole bunch of needs that you don't even know about, but will impact your daughter. Like, if we built a computer center last year, we need a lot of computer science kids. 2 years from now, we don't need that many computer science kids. So some of what we're trying to do and what you as people seeking capital are going to need to try to do is, can I put this person together with that? Can I find somebody who is interested in environmental if that's what I'm doing? Can I find someone who's interested in workforce development and pair them with someone who's interested in environmental because we're the tree trust or something like that? And that can be really powerful and meet your objectives while allowing them to meet their needs.
I think when we think about different flavors, or I'm not sure what you said, investors, especially, I'd say, especially here in Baltimore, at least in my experience, have been very much focused on place. How do you create community? How do we provide resourcing to build an ecosystem that is successful for everybody? And so when you have an institution, we work with an institution that is a large healthcare institution. They look at their work as kind of the broad social determinants of health. They are very much in community. And so they're saying, we don't want to limit ourselves to investing in folks who are just working in providing healthcare to community. We want to make sure that there's food access. We want to make sure that there's housing and job creation. And so they've taken a very broad look at their mandate. And they've said, give us ideas of organizations or companies in town that we can look to support. And it's very much about place. And so I think that while some organizations, I'd say the exception to that at times can be those organizations that we work with that are very focused on environment, but even environment today has become much more broad in terms of what does environmental justice look like? How does the environment affect urban populations? It's just become a much more broad conversation than I think it used to be. Yeah. So there's a lot of room right now, I think, for kind of making the case, telling the story, bringing the partners in. It can become a really nice kind of end story.
Yeah, but I do think it is important that you kind of understand where they're coming out of. I agree with you that it's getting blended, but where they're coming out of in terms of their perspective is also helpful.
Yeah.
Hi, so I'm the founder of Femly, a venture-backed feminine care startup, and we raised our capital with the mix. So we did about 1.2 million in grants, 2.5 million in venture, and we're looking to raise an 8 million Series A right now. What's interesting is that I have done my best to stay close to home with impact, and we learned about a newer vehicle to me called a DAF, a donor advised fund. So this week we actually launched our Femly Foundation, but I think the goal for us would be to leverage this round to align ourselves with mission-oriented impact investors, philanthropic organizations that might care about our impact on period poverty and education in schools. So with regard to that specific vehicle, a donor advised fund, what are some of the things that you all are seeing? Because I would very much like to keep my company in Baltimore, but as it stands, we don't have a dime of Baltimore funding.
Interesting.
I'm not a DAF expert.
Also, I love my Kinkin. We work out of the second floor at Brown.
Yeah, you do. So what's your name? Ariana.
She's killing it, by the way.
I'm well aware.
Yeah.
I'm well aware. So we have a small kind of accelerator space on the second floor of our building, but there are a number of really awesome accelerators around town.
We're sitting in one.
We're sitting in one. We should talk. We should talk because I think I'm interested to hear about the DAF structure. So for those that aren't familiar, a donor advised fund is essentially a fund that sits at a sponsoring organization, a sponsoring charity, typically a community foundation or a corporate foundation. But it is typically a grant-making only vehicle. So I'm curious to hear how you got connected in that. That said, it's interesting to me, and I'd love to hear your story about kind of the Baltimore funding scene, because I can tell you that venture and early kind of equity capital is, I think, a little bit more new for foundations and investors here in Baltimore. So far, what I've seen are less direct deals and otherwise deals through a fund structure. So essentially what that means is that for an investor to think about allocating equity capital to a company, that's taking a lot of risk in kind of like putting all of your eggs in one basket kind of a thought, right? Unless you're really confident and comfortable with one particular company. Otherwise, they're looking to kind of diversify their risk in a fund structure. So that's why I see a little bit more on the fund side, but you've been doing such incredible work. I'm surprised to hear that. So I'd love to talk with you a little bit offline.
You know, there's
We have mission-related investors that are coming in, but their investment is tax deductible for them through the DAF. But we'll talk.
Yeah, let's talk.
So it's interesting. I'm reminded of a story. There's a guy that some of you may have met, a gentleman by the name of Luke Cooper, who's causing a lot of trouble in town right now, in a good way, by the way, good trouble, who had the same, I'm dying in Baltimore. And one of the things I think that's interesting about capital raises in general, but perhaps maybe a little more so in this town, is persistence is key, right? So, you know, I grew up in sales, and it's just, okay, just make the next call. You know, just knock on the next door, right? So, A, I feel your pain, but B, I think, you know, there's an old saying that I'm going to murder, which is basically that you only lose if you don't take the next shot, right? So,
I think your point about kind of dying in Baltimore in that regard, we're still learning. This is a group of investors that's still learning how to do this. And so I know that's hard to hear as somebody who's really killing it, right? But I think investors are still learning. So I totally echo what Jim is saying. I think, I know it's hard. I know you've already been overly patient, right? But we're a little slower sometimes to figure it out.
And this is an industry, Baltimore is not unique in that regard. Okay, so this whole notion of impact investing is a new thing for everybody. You know, and maybe there's cities in the U.S. that are doing it better than Baltimore. You could debate that. You could debate whether there's other countries that are doing it better than the U.S. is doing it, right? But it's still a new thing overall.
Especially equity.
Yeah, I would just throw in, and some of this is a shameless plug, but because we're sort of aligned with the city, but at least on the debt side, to the extent that that is an experience, or to the extent that you're talking to folks out of the city, you know, we would be very interested in talking about that, because my experience is that, you know, one of the challenges that Baltimore has is we don't have the best reputation, as you know. We're not the easiest place to invest. People are scared of city government. There's been a lot of turmoil. You know, I view part of what we're here to do as to make it safe for people to get in the water. And we consider it a huge positive if there's somebody else in this deal who's bringing in capital from outside the city. And part of what we would suggest to people as to why we should be in a transaction is to frankly play that role, to help them feel like it's safe to get in the water here. Not that we have special access to get the phone answered, but we are here, and if we have skin in the game, we will work hard to get the damn phone answered. I think that's hard. I was at a CDFI in DC that had the ability to invest in Baltimore. I brought the CEO up here, drove around, and his comment was, well, there's plenty of mission, that's what we're all about, but tell me where we're aligned with partners, tell me where the city's priorities are, tell me where we're going to have partners in the transaction who are local. That was a huge issue for him. I think that to the extent you are talking to folks outside the city, if I were them, and it's a little different in venture, but in general, I still think people want to make sure that they have somebody on the ground who's keeping an eye on things, and particularly, again, on the real estate side, because there's so much public involvement, it's a little more intentional. But I think, and I can speak for others in the market, one of the things that we are generally not looking to elbow other people out of the transaction. So it is generally a plus if you can say that you helped bring in outside capital, and I think people would be very favorably responsive to it.
So I totally lost my train of thought because this is one of my brilliant students over here. So she raises her hand. I want to talk.
advice. I have a project that I'm in the startup phase, and I need to raise money now, but I can just use an example, Weinberg Foundation. I wrote a grant, and I got through to the point where they said, we want to see. And I had one of their grant managers call me and yell at me, who do you think you are? You don't even have audited financials, because I started. And I'm like, but I got through. So obviously I'm doing something right, but I don't have the money. So what he told me to do was go out, find an individual funder, find somebody you need cash to show that you can do it. So I've kind of tried to do that, and I've gotten a little bit of money. I think at the end of this year, this is for the foundation side of my venture, and I'm gonna have about only $100,000. I need to raise like 1.5 million. So what's your advice to how do I prepare to come to one of you guys and say, okay, I need money, can you help me? Does that make sense?
I will confess that I'm not on the foundation side, so
Okay.
I don't speak funder. I
Right.
did, we have raised some money from funders over time, and I think they all have different objectives. It's a little bit back to if we had a computer center, we need a lot of computer kids this year. I think it's at times I've seen everything from we want a clear vision and a clear path to something that's demonstrable and achievable to your vision's not big enough. So it's a little bit hard to figure
that's
that out.
that
And
when you've seen one kind of a thing.
yeah,
So
I'm not
it's-
sure that on the lending side, it is about having a financial plan and having financials and this kind of stuff.
I've structured this business as I have a for-profit it's for transitioning youth with disabilities and kids and everything like that. So I have the for-profit side for anything built to insurance with the funding on it. So I have both where I could get, and my vision is big, and that's great. That's right. Like, I see here and I just want to get here.
Welcome to entrepreneurship.
Right. So I'm like, how do I get the money to be able to do what I'm doing? Because here's how I know it's going to work. And I know that this doesn't matter, Jim. You told me. Just because I know it's going to work, it doesn't matter. The numbers, everything.
It's really cool when your students read back to you the conversations you've had with them.
You've well prepped her.
Justice is amazing. I want to tell you this. Can we convince to just refer a patient of theirs to my center because they can't get this particular patient into their seating plan for months? I got a referral for the same thing. They can be treated with us. I know it's going to work.
So we've got just a couple minutes left, so I'm going to ask you to take. No, that's fine. We're not going anywhere when we're done. So we're happy to have sidebar conversations with anybody that wants to pick these wonderful brains or this very small scattered brain. But there's a point I want to get to, partly because it scratches my own geekiness. So I'm going to take the sponsor's prerogative on lighting the candle on this particular geeky corner, which is that one of the things I think is really fascinating about impact investing that's different, and this is more on the entrepreneur, I think, than on the investor. It's one of the things I think we're not good at as social innovators, as folks trying to do good things, is developing the quantifiable demonstration of the social return, okay? So if you've got a program where you can reduce the rate of recidivism, right? Fewer people go back to jail. You are saving the government money. And the traditional nonprofit says, aren't we good people? Give us another grant, right? So when you're thinking in an impact investing mentality as an entrepreneur, down the road, and I know you're not there yet, but down the road, that mentality, I think, is something that's starting to make sense on the investor side as well. And what there's an old term in venture capital where they talk about early stage money being patient capital. And what we're talking about here is sort of like double extra patient capital or something like that. I don't know. But I'm curious what you guys are seeing in terms of people being able to quantify those points
Yep.
to capital.
So this is what I think is kind of commonly referred to as impact management and measurement. And it is so early days, I think. And I say that because partly because we're coming from a do-good kind of mentality, and partly because we're trying to blend the do-good mentality with the investor base. And then you add in the additional wrinkle that that the investor, the funder, has their own definition of success. So, if if you are a foundation that is focused on making sure that that there is access to healthcare for girls in populations like this, your purpose is going to be X, right? And if you're an organization that's focused on building sustainable housing with kind of workforce development, inclusive, that definition of success is Y. So how do you reconcile those as a funder? And so, so I think there's this attempt right now, and there's been a really great attempt, and a lot of it has come out of the conservation and environmental kind of effort around the UN's Sustainable Development Goals, which frankly I think is the best thing we have today to try to bring everyone together in terms of defining what actual impact themes are, and then allowing entrepreneurs to say, hey, we check box number 7, 10, and 12. And if that's something that you're interested in, then we have a really great alignment. And then you can provide some reporting on that. But I think it's really important to understand, what is the investor, what does success mean for that investor? And can you somehow tie the work that you're doing in a quantifiable way to that investor's definition of success? But I think,
So I think for us it was interesting because we had a bunch of organizations that looked at us and thought that the thing that we should measure should be how many pads and tampons are given out. But in reality, the thing that both our customers and impact investors cared about most was the fact that we're decreasing linen disposal in hospitals and
Yeah.
schools, and we're increasing patient experience scores across healthcare. So it's like, with you, the thing that you measure might not be the thing that they're telling you to, but it's the thing that they care about enough for you to throw a case study in there and say, here, find this, here's why.
and that's where philanthropy, I think, has done, in some ways, kind of philanthropy's idea of what success means and what metrics they should be counting don't always line up with what you all are doing, with the work that you're doing. And so it takes a little bit more time to kind of make the case. So I think providing case studies and that sort of thing is really, really helpful.
Okay. I think we've hit most of our notes. So no. You guys did a good job. Before we leave, first of all, if you do not know the two amazing women in the back, you need to know them because they are the lifeblood of the emerging technology centers. And if you don't know about the emerging technology centers, you should definitely be hip to it because they've been throwing it down. Gosh, Thank you. I'm trying to think. I've run 2 startups through emerging technology centers in my career. So Deb was 5, I think, when I did the first one. But thank you for having us. Thank you, Bridget. Thank you, Mark. We'll be around. There's food in the back. University of Maryland Graduate School teaches this stuff. So if you're interested in getting a deeper dive, come see us. And thanks for your time.